Good evening. Please come to debt securitization. In the previous lecture, we have seen the basic working of debt securitization. Okay? So, what is debt securitization? Remember that diagram. There is a customer. He goes to SDFC Bank. SDFC Bank transfers it to SPV. SPV issues instrument. So, based on that story, this entire note will be understood. Debt securitization refers to converting retail loan into wholesale loan and then reconverting into retail loans. So first they give loan to large number of people, then they pull it together and again they divide into small instrument of 100 rupees, 300 rupees, 1000 rupees so that they can sell it to large number of investors. Next is for example, a bank lends rupees 10 lakh each to 300 borrowers as a part of its loan portfolio. So the total value of this is 330 crore. What they will do, they will raise funds of 30 crore by issuing debt instrument, and each unit of the debt instrument will be of 300 rupees each. So 30 crore divided by 300 is how much? 30 crore divided by 300. 10 lakh. That means they will issue 10 lakh debenture of rupees 300 each. So that even ordinary investor, if they want, they can subscribe. The philosophy behind the arrangement is that an individual body cannot go on lending sizable amount for about a longer period continuously. Okay? That means if you go to bank and say I want to borrow 30 crore, you will not get it. But if you go to 1 lakh people or 50,000 people and say you invest 15,000, 30,000, then you will be able to raise the funds. But if that loan is divided into small pieces and made transferable also, investor can sell it in the secondary market, it becomes easy to finance large projects having a long gestation period. So there are few practical examples of debt securitization given, like for example HDFC. It's basically used by banks and financial institutions because they have a lot of receivables, loans in their balance sheet, and they recover it over a very long period of time. So instead of waiting, they can securitize it, raise cash, again give more loans. So the experiment has already been initiated in India by the HDFC by selling a part of its loan to IL and FS, infrastructure leasing and financial services, and has therefore become a trend setter for other kinds of debt securitization as well. So basically those companies which are into housing finance, they use this more often. The reason being, there is a security in the form of house. If something goes wrong, you can sell that house and recover the money. The HDFC has entered into this agreement with ILFS to securitize its individual housing loan portfolio to the extent of rupees 100 crores. So this securitization ticket size is how much? 100 crores. Debt securitization will thus provide liquidity to the instrument. As a market maker, ILFS will quote a bid and an offer price for the paper. Quote a bid price and offer price means they will be buying also, selling also. Two-way quote. This line is not important, don't bother. What is debt securitization? Understand. There is one more company called ICICI, somewhere below it is written, as well as other private financial companies have been trying similar deal for lease rental. Another area where this debt securitization is very popular is lease rental. I will explain if you are interested in knowing. Suppose you are a landlord, okay, and you've given your property on rent for 5 years, and you're going to receive 5 lakh over next 5 year as rent for next 5 year. So you go to a bank today, you tell the bank, see, I have this 5 lakh rupees receivable for next 5 year. You give me the loan and I assign you this future rent receivable. Okay. So what bank will do? Bank will calculate the present value of this future cash flow, that is present value of lease rental, and bank gives you the loan. And how this loan will be repaid by the company? By future lease rentals. So as and when the future lease rental will be collected, it will be used to pay to the banks. So therefore this securitization can be used in the business of lease rentals. If you have lease receivables, you can securitize it, raise more money. Using this borrowed money, again create one more flat, okay, give that also on rent. Using that rent receivable, again borrow more money. So you can continuously recycle the funds. Next is, some finance companies are also following the same route. If you have credit card receivable, automobile receivable, okay, nowadays mobile loan receivable, education loan receivable, are also following the same route for financing promoters' contribution for the projects. So they can raise the funds against some future receivable. Given the scarcity of resources and to provide flexibility to investors, innovative financing techniques such as debt securitization, which will mobilize additional resources through a wider investor base, is a step in the right direction. That means this is a very innovative financial tool. Innovative. Because earlier, before this debt securitization, once the loan is given for say 25 years, now it will remain in your balance sheet for next 25 years. Every year you will get EMI or one loan installment. So it becomes illiquid. But through debt securitization, you can convert illiquid asset into liquid asset, and therefore it will promote more and more transactions in the financial markets. It will increase the profitability of the banks. A major trend in the international financial market in recent year has been towards securitization of long dated asset held by them as security or mortgage against credit to the customer. So this is globally also, this is very much in use. As I told you yesterday, the volume of transaction in US financial market for debt securitization goes into $1 trillion per annum, one followed by 12 zeros, that too in dollar. To convert into rupees, multiplied by 75 also, or 72. Okay. So what they do, they specialize in this field only. Banks specialization is in identifying the customer, understanding his ability to repay, doing all the documentation so that in case if he doesn't pay, we can recover it by selling the asset. Whereas the other entities, which are SPV or asset reconstruction company, their specialization is financial engineering. That means converting these loans into securities, issuing it to the investor, raising the funds, etc. Debt securitization. So this is one development. Yesterday you asked me that is it the reason for financial crisis in USA? To some extent, yes. To some extent, yes. But you can't blame the instrument. You have to blame the user. So in USA also, in 2008, which is called subprime crisis, you might have heard of. Okay. So what was the problem? Suppose there is a bank. It used to give loan against house property, home loan. And while giving the loan, what they saw that this person is having a house, is giving it as a collateral, right? So suppose a driver comes, watchman comes, just example, or poor person come, let us write poor person, otherwise somebody will feel bad about it. Somebody is working in the homes, their salary may be say $2,000 per month. He said, I want to buy this house. Bank gave them loan of $1 lakh. What is the salary? $2,000 per month. What is the loan? $1 lakh. What is the value of the house? $1 lakh. In USA, black market is not there for real estate. Okay, at least I know whatever I know. So bank knows that this house is worth $1 lakh. I have given a loan of $1 lakh. What if this person doesn't pay? At least I have the security of a house whose value is equal to the loan. And banks are given target. Okay, the sales staff of the bank, they are given target by the top management that this year we have to create a loan book of this much amount. If you don't do it, you are fired. Okay, you will not get commission, bonus. So in order to increase the loan book, they will give loan to even people who cannot repay. That is why it is called subprime. Prime means good customer like you. Subprime means bad customer who do not have the ability to pay. Subprime, substandard. Okay. Then they kept on giving the loan, and what they did, this loan they securitized also. Even the other entity, those who purchased this loan, they were also thinking like this only. What if this customer doesn't pay? We will sell the house. Okay, the investor of the security also thought like that. Then even insurance companies who gave insurance policy, they also thought like that. In fact, they thought that it's a very good deal and they charge a very lower premium for underwriting such a risk. Okay, because they thought that this loan is of $1 lakh, that house is of $1 lakh, so we are safe. So whatever premium I will get is my income only. And they sold it to different countries, different parties, world over, wherever they could securitize, they securitized. Is it right? Even credit rating company, they also said the risk is less. So everybody just relied on that one house whose market value is $1 lakh, loan amount is $1 lakh. This is a simple way of explanation. But then what happened after some time? These people started defaulting. The driver whose salary is $2,000, he was not able to repay the installment. The watchman whose salary is $3,000, he is not able to repay. So what banks did? Banks dutifully took over the property. Okay, 1, 2, 3, 4, 5, and then the inventory of the house property started accumulating. And many banks were doing the same thing because it is a competition. If others are doing, I will also do. So banks were owning now house property which ran into thousands, lakhs, millions. It seems as if their business is not to do banking business, but to manage the house property. And now they thought, okay, no problem, let us sell and recover my money. So can you now guess what must have happened? There is so much of supply of house property. There are only sellers now left, no buyer. So $1 lakh worth house is now $20,000 because supply has increased so much. Okay. So they lost a lot of money. Insurance company had to pay a lot of claims, right? So that is a subprime crisis in brief. Of course, entire world will go into recession because all financial markets are linked with each other. Banks started defaulting on payments. Is it right? Derivatives were created on these products. Complicated derivative products were created. So even there the people started losing money. So much that one big investment banking company in USA, Lehman Brothers, got liquidated. Few more which were also very big at that time, they also got liquidated. US government had to step in to bail out. So this word bailout was very popular. Bailout means US government will give funds to many financial institutions so that they can survive. Okay. But because these big banks were in trouble, many people lost their jobs because they were liquidated, closed down actually. Okay. So that is the problem. But is it a problem of debt securitization or is it a problem of excessive greed of the people who manage the show? It is a greed. While giving loan to a person, you have to see his ability to repay. Okay. And you can't just only rely on the collateral. Because in US market people were very scared. So Indian market also suffered, but less because in India 20% or 30% of the house property is given in black. So even if the price crash, it doesn't make much difference. It will become equal to loan amount. So black money saved us. Okay. After that, accounting standard on financial instruments were rewritten so that now the investor will be able to assess when they see the receivable or advances or loans in the balance sheet, they will be able to guess something that there is something wrong here and they can make judgment. More disclosures were required. Okay. So IFRS 7 was issued dealing with disclosures about financial instrument. Then IFRS 32 was revised. New IFRS 9 was introduced. Based on that, now we have three standards in our Ind AS also: Ind AS 32, Ind AS 109, Ind AS 107. They are very detailed because they will help you to get the idea about the risk involved by investing in such companies. So you have to give lot of disclosures. Okay. Now the next is money market mutual fund. If you want to learn more about the financial crisis of USA, there is a book called Too Big to Fail. Okay. So once you pass, then you read because it's a little bulky book. 300 plus pages are there. Too big to fail. Some of the US banks thought themselves that they have become so big that they can't fail. But then the 2008 financial crisis indicated even if you are too big, you are also subject to failure. You may also fail. Okay. So Too Big to Fail is an award-winning book. You should read because you are into this field. Okay. And during this period, there was one more book I read on this financial crisis. Long Short, something like this. The Long Short. The long short means, again, this word short here means short selling. Short selling increased in this period too much because prices were falling every day. So how will you make profit in a falling market? Short selling. So the long short. And then they have described how the US market collapsed during this period. Okay. But these are very technical books. Only if you understand finance, derivative, portfolio, but you will be able to understand now. You have been trained so much. Topic today is what are the recent innovations in money market. One was debt securitization. More about debt securitization, SFM book. More information on debt securitization is given in your Group 1 SFM book. Read from there also. I did not want to duplicate the information. The next innovation is money market mutual fund. Suppose you want to invest in treasury bill, direct participation in treasury bill by a retail investor is not allowed. Or you want to purchase commercial paper but you need minimum 25 lakh. Or you want to buy certificate of deposit. Again the minimum size is very high, 5 lakh. But after learning the lecture on money market, you are very keen. No, I want to buy treasury bill. So there is a shortcut. You invest in money market mutual fund. And since lakhs of people will invest in money market mutual fund, they will have a huge surplus, huge corpus, and then they can purchase the money market instrument. So indirectly, anybody who wants to invest in money market instruments can invest through MMMF, money market mutual funds. One of the recent developments in the sphere of money market is the establishment of MMMF, the guideline for which have been made public by RBI. So who has issued guideline? RBI. MMMF can be set up by the banks and public financial institutions. Who are allowed to set up this MMMF? Banks or public financial institution. There can also be money market deposit accounts. Now what are the rules and regulations? Quickly I will go through it, but keep in mind any regulation relating to money market mutual fund you have to refer here. First is the limit. The limit for raising resources under the money market mutual fund scheme should not exceed 2% of the sponsoring bank's fortnightly average aggregate deposit. Banks can use money market mutual fund, okay, but the amount of funds they will raise will not be more than 2% of sponsoring banks fortnightly average aggregate deposits. If the limit is less than rupees 50 crore for any bank, it may join with some other bank and jointly set up MMMF. So two or more banks together can also come. If they find that 2% of the aggregate deposit is below 50 crore, because then it will not be very profitable to work with such a low volume. So two or more banks together can set up the money market mutual fund. In case of public financial institution, this is for banks, first two lines. For financial institutions, in case of public financial institution, the limit should not exceed 2% of the long-term domestic borrowing as indicated in the latest available audited balance sheet. In case of banks, it is 2% of average aggregate deposit. In case of financial institution, 2% of long-term domestic borrowing. Next is eligibility. MMMF are primarily intended for individual investors. As I said, you can also invest so that you can indirectly participate in money market instrument, including NRI, underline, who can invest only on a non-repatriable basis. MMMF would be free to determine the minimum size of the investment by a single investor. So who will determine minimum investment size? The respective mutual fund, because it's sometimes I think as low as 5,000 rupees also. So you can also participate. Your 1 month stipend for 2 months. 2 minimum rate of return, like any mutual fund, There is no guaranteed rate of return. Mutual funds are subject to market risk. Okay. So, although there will be some return, but it is very low, because the source from where they earn interest is also very low rate of interest instrument only. Treasury bill maybe 4, 5, 6%. Certificate of deposit maybe just 7, 8%. So the rate of return usually is very high, but it is good for people who want to invest in safe instrument for short period. What is the minimum lock-in period? 46 days. Deployment of capital. Where is the money invested? As you know, it will be invested in various types of money market instrument. Okay, they can't invest in share market. Investment limit. Treasury bill and dated government security having an unexpired maturity up to 1 year. So they will have to invest up to 25% minimum they have to invest in treasury bill and government securities whose unexpired maturity period is up to 1 year. So these are very short term instrument. Yes or no? Very short term, because the maturity period is less than 1 year. 25% or more of your money should be invested in this one. Then call or notice money, they should invest minimum 30%. Unexpired maturity. That means now the maturity period remaining is only 12 months. Remaining maturity period is only 1 year now. You may have purchased it in secondary market. Remaining maturity, what you have heard, now suppose it is issued for 3 years, 2 years are over. Now only 1 year is remaining. That is called unexpired maturity or remaining maturity from the date of purchase. Remaining maturity from the date of purchase is unexpired maturity. So suppose a bond has a life of 5 years, you have to purchase it in the last year only. Then the unexpired maturity is 1 year. Call or notice money, you have to invest minimum 30%. Commercial paper, you can invest maximum 15%. Why here you have written maximum limit? Because commercial paper are riskier than treasury bill and call and notice money. Commercial paper are issued by corporates. This is issued by government, so almost no risk. This is again by banks, so almost no risk. But here the risk is high, so therefore there is an upper limit. You can't invest more than 15% of total money in commercial paper, and that too in one individual company it should not be more than 3%. Your exposure to one single company in commercial paper should not be more than 3%. And if you invested in commercial paper of many companies, then all of them put together should not be more than 15%. Then commercial bill accepted or co-accepted by banks. So here also you have a maximum limit on 20%. These are little subject to risk. Yesterday we have learned commercial bill can be discounted by the banks, yes or no? That is rediscounting. So here you can have a maximum exposure of only 20%. This is investment limit. Certificate of deposit, no limit. Any amount of money can be invested in certificate of deposit. So this would be like a balancing figure. First you see all these limits are matched, and still if you have some money you can put in certificate of deposit. So that is about money market mutual fund. This will be repeated again in one more chapter. Mutual fund chapter, which is coming soon after some days. Okay. Mutual fund chapter is there in your group 1 of SFM. Same chapter with more detail in this subject. Okay. Now the next instrument which we have studied in one previous chapter, repo and reverse repo. Do you remember something like this? Revisit. Repurchase option, in short called repo, reverse repurchase agreement, in short called reverse repo, and these instruments are also called ready forward contracts, RF, ready forward contracts. So we will see why these are called ready forward contracts or repurchase option or reverse repurchase option. Very important from exam point of view. You will certainly get one question from this repo. The term repurchase agreement and reverse repurchase agreement refers to a type of transaction in which money market participant raises funds by selling securities and simultaneously agreeing to repurchase the same after a specified time, generally at a specified price, which typically includes interest at an agreed upon rate. Okay. So it is like this: bank and RBI. This bank will first sell security to RBI, but there is an agreement, it will be repurchased again after a certain point of time. Okay. So it's like buyback arrangement. If this is sold at 96 and it is bought back at 100 rupees, the difference represent interest. The difference represent the interest. So if the bank approaches RBI to sell, okay, then it is called repurchase option. Okay, repurchase option. So if RBI purchases with an option to sell, it is called reverse repo. If RBI initiates the transaction, okay, and it purchases with the agreement to sell it later, then it will be called reverse repo. Okay. So reverse repo will be when you purchase with an agreement to sell, and repo means when you sell with an agreement to repurchase. Okay. So whether it is a repo or reverse repo depends on who initiated the transaction. Theoretically, what is repo for one party is a reverse repo for another party. But repo means the one who sells the security initiated the transaction. In our example, bank. In reverse repo, the one who purchases the security initiates the transaction. And the difference is the interest. So it is in accountancy, if you have learned financial instrument standard, in this example, we do not de-recognize the instrument in the books of the seller because he is going to purchase it back. So de-recognition does not take place for accounting purpose in the books of this bank. Rather, the amount received from RBI will be treated as loan taken from RBI. Substance over form. It's an example of substance over form, where in substance it seems you are selling and buying, but in form it is a lending and borrowing arrangement. Okay. So it is not recorded as a sale and purchase transaction. Rather, it is recorded as a lending and borrowing arrangement. Difference is treated as interest. Sometimes it is also called ready forward contract, RF. Why? Because you sell now and you enter into an agreement to buy it at a future date at an agreed upon price. So as you have learned the definition of forward contract, contract to buy at a future date at an agreed upon price is called forward contract. So therefore sometimes they call it ready forward contract, as it involves funding by selling security held on a spot, that is ready basis, and repurchasing them on a forward basis. So combo of two words, ready, you are selling now, and you are purchasing at a future date, forward. Next is the repo market is mainly a buyback arrangement. Under such an arrangement, the seller sells specified securities with an agreement to repurchase the same at mutually decided future date at a price. Similarly, the buyer purchases the security with an agreement to sell the same to the seller on an agreed date in future at a prefixed prices. Now, for one party, it is an option to purchase later, for other party, it is an option to sell later. Now, this is done. Why such transactions are initiated? To bridge the short-term gap of either cash flow or security. Sometimes the banks sell it because they want to raise funds. Sometimes such transactions are entered into to meet your SLR requirement. Is it right? To meet SLR requirement also, such transactions can be initiated. This question we discussed in the earlier chapter also, once again, and they can ask you directly for 4-mark question or a 3-mark question. What are the differences between repo rate and reverse repo? Mark important, direct question possible. First is repo rate is the rate at which RBI lends to commercial bank for a short period of time against government security. Who lends to whom? RBI. Reverse repo is the rate at which commercial banks lend to RBI. Next, a transaction is called repo when viewed from the perspective of the seller of the security, that is a party acquiring the funds, and reverse repo when described from the point of view of the supplier of the funds. Thus, whether a given agreement is repo or reverse repo largely depends on, underline, who initiated the transaction. The purchase of repo is to fulfill the deficiency of funds. Why repo is initiated by commercial bank? Because generally they need the money. Why RBI initiates reverse repo? To maintain the liquidity in the economy. Okay. That means they can use this instrument to increase or decrease the liquidity, money supply, inflation, etc. So it's more a monetary policy tool, reverse repo. So repo rate is comparatively high in comparison to reverse repo rate. Otherwise you will take a chair, sit behind RBI's office, borrow from them and lend it to them only and make money, right? So repo rate is the rate which banks pays to RBI. Reverse repo rate which RBI pays to the bank. So of course reverse repo rate has to be lower. Otherwise you don't have to work. Just keep dealing with RBI only. Repo rate objective is to contain inflation in the economy. Because if RBI thinks that market rate of, if the demand for money is too much, increase the rate of interest, increase repo rate. If you increase the repo rate, demand for funds will go down. If demand for funds will go down, it will contain the inflation. Whereas reverse repo rate, the intention is to control the money supply. So here the direct variable which is affected is money supply. Indirectly it will also affect the inflation also. Okay. Repo rate you directly increase the rate of interest only. Whereas in reverse repo, first effect is on money supply and then through money supply, inflation and interest are controlled. Next point of difference, repo is based on repurchase agreement. That is, there will be an agreement between two parties on the condition that one party will sell security to other on the promise that it will be bought back by him after a certain period of time. Whereas reverse repo is a reverse repurchase agreement which is just the opposite. Purchasing with the objective of selling at a later date. Now next important paragraph is characteristics of repo. So some important points we'll discuss. First is origin. How did repo transactions originated? Repo transactions are of recent origin which has gained tremendous importance due to their short tenure and flexibility to suit both the lender and the borrower. So what banks can do? If they need money, go to RBI because they already have lot of government securities and raise money. So according to the tenure, according to the amount, you can use this instrument. So it is a flexible instrument. Okay, you can customize according to your needs. Under this transaction, the borrower places with lender certain acceptable securities against funds received and agrees to reverse this transaction on a predetermined future date at an agreed interest cost. So simple. And it is a hybrid instrument. Why it is a hybrid? Why it is called a hybrid? On one hand, it is a selling and purchasing instrument also. You are selling and buying. On the other hand, you are using it for lending and borrowing also. Hybrid means it represents two things. Sell purchase also, borrowing and lending also. So that is why somebody calls it hybrid instrument. In many respects, repos are hybrid transactions that combine features of both secured loan and outright purchase. So it has a feature of lending and borrowing and purchase and sell transaction, but do not fit clearly into their classification. So this is a complicated instrument for accounting purpose also sometimes. Whether we should treat it as a borrowing or whether we should treat it as a sale. Other party, whether I should treat it as a lending or whether I should treat it as a purchase. So for that you have to refer your Ind AS 109. Okay. So in Ind AS 109 you will learn the accounting treatment of repo. If the risk and reward is transferred substantially, de-recognize the collateral. Otherwise, continue to recognize the security in your book. Amount received will be treated as loan from the other party. Okay. Why I am teaching you accounts? Okay. What is repo rate? The lender or the buyer in repo is entitled to receive compensation for the use of funds provided to the counterparty. So in this example, RBI provides funds. So RBI will charge them interest. And this is very popular nowadays in the Indian economy because this is like a benchmark rate now. On the basis of this, many other rates are decided. Whenever RBI lends money to the bank, it is now called repo rate. If they want to give an indication that interest rates are increasing, they will increase the repo rate. If they want to give a hint that interest rates are decreasing, they will reduce the repo rate. And accordingly, all other interest rates are also aligned. Okay. And always there is a war between the government and RBI. What is that war? Government says you reduce the repo rate so that more money can be circulated in the economy. RBI says no, if more money will be circulated, it will cause inflation. And our duty is to control the inflation. So that is a bone of contention between government and RBI. This is accomplished by setting the negotiated repurchase price over the initial sale price. The difference between the two represents the amount of interest or repo rate owed by the lender. Now next is characteristic. Continues. The repo rate is negotiated by the counterparties independently of the coupon rate. Underline. Coupon rate on that bond or debenture will be different. It may be 10%, but repo rate may be just 5.5%. So coupon rate on that bond and the repo rate will be different, or rates of the underlying security, and is influenced by the overall money market conditions. In India, repo rates are determined on the basis of expected call money rates. But it is a monetary policy. RBI determines it. Now, what is the maturity period of repo? It can be very short, like 1 day, overnight. It can be few days or months. The minimum period of repo in India is fixed at 3 days. So in Indian money market, it is 3 days. But globally, in some countries, it can be 1 day also. Elsewhere in the world, longer term repos are arranged for standard maturity between 1 day to 1 year. So globally, it is 1 day to 1 year. What about the interest rate? Interest rate is market determined. and is built in the structure of the repo. And is built matlab difference between the amount at which you will purchase and the amount at which you have sold, that difference is designed in such a manner that you get your desired rate of return or repo rate. Okay. Eligibility. Who can invest? Who can undertake this repo transaction? Repo transactions in India: commercial bank, financial institutions, brokers, Discount Finance House of India, DFHI. And who are prohibited? What is prohibited? At present, repo transactions have been prohibited in all securities except treasury bills. However, there is a committee called Nand Karni panel set up for examining transaction in PSU bonds and UTI units, have recognized the importance of this instrument as a money market instrument and recommended its reintroduction. Now I'll explain. It is written in the first paragraph that repo transaction is allowed only for treasury bill. It means other instruments cannot be used for repo. But this panel called Nand Karni panel, they have said we should allow other instrument also for repo transaction. Okay, so it has highly recommended that repo should be used more and more instruments should be allowed for conducting repo transaction. Okay, so that is about this one. Now the next is the boss, RBI, the boss. Okay, what is the role of RBI in money market? So our discussion now will be restricted to the role of RBI in the money market as a regulator, as an administrator, as a facilitator, okay, as a watchdog. What RBI will do? RBI intervenes in the money market as and when required by conducting repo through its two subsidiaries, that is Security Trading Corporation of India, Discount and Finance House of India. So suppose they feel that money supply has gone up, they will conduct repo and reverse repo transactions. And who conducts this repo and reverse repo on behalf of RBI? There were two subsidiaries, Security Trading Corporation of India and Discount and Finance House of India. So they will buy or sell government security, influence money supply. Next line. The central bank banned these transactions, that means repo transaction, between banks following their misuse to divert funds from the banks to the stock market. You have heard this Harshad Mehta scam in 92, 93. Is it right? Long back. So what was the purpose of banning repo? You take loan from RBI and you invest in the share market. That is what they did. And they give loan to their customer for investing in the share market. So it is not a good thing that you borrow money from RBI for the purpose of share market investment. And in 1992, Indian share market was not a matured market. Okay. So therefore, lot of scams took place during this period. So they banned it. The first thing in India we do, instead of fighting against it, first you ban. Okay. Good or bad? Good. Then later on we will see what can be done. RBI has permitted repos in dated securities. Now underline the meaning of dated securities. It has come in earlier discussion also. Yes, so I did some R&D on this dated security in Google, and the meaning I found in a lot of website is this one. Dated securities are long-term securities or bonds of the government that carries a fixed or floating coupon. then why we are discussing here? Maybe the maturity period remaining is less than 1 year. Maybe the maturity period remaining is less than 1 year. But in case of repo, you can trade in dated securities. RBI has permitted repo in dated security and reverse repo transaction. So now they have permitted. In addition to treasury bill, you can use dated security, which means long-term government security which may carry fixed rate or floating rate of interest. RBI has permitted repo in dated security and reverse repo transaction by non-bank subsidiary general ledger account holders. This I will explain later. So non-bank subsidiary general ledger account, under this you can do the repo and reverse repo. In the lean season, credit policy announced in April 1997. Some entities can maintain SGL with RBI. What is SGL? Subsidiary general ledger account. Non-banks means it is not a proper bank. NBFC. It can be mutual fund also. It can be insurance company also. Other than bank, if they want to trade in repo and reverse repo, they have to open a subsidiary general ledger account with RBI. Okay, little complicated, you don't bother much. And then you can do the trading in government securities through this non-bank entity. Non-bank entity example, NBFC, mutual fund, insurance company, corporate also you can write, holding SGL account. So they have to open a SGL account in RBI, okay, through their banks. It's little complicated. They have to approach their bank, and through their bank they have to open an SGL account in RBI, and then they can use government security for repo transaction, can lend their surplus money to banks by entering into a reverse repurchase agreement or reverse repo. So you are a non-bank entity, you can lend money to your bank. Then this bank will inform the RBI. These entities entering into reverse repo with banks purchase permitted repo securities from banks with a commitment to sell the same at an agreed future date and price. Okay. So they are allowed to enter into reverse repo transaction, purchase with an agreement to sell it at a future date. Where there is a spurt in the call rate, what is the meaning of spurt in the call rate? Increase. RBI intervenes through STCI. What is STCI? Securities Trading Corporation of India and DFHI, Discount and Finance House of India, by conducting these repos to inject the required liquidity. Is it right? So RBI will purchase the government bond and give money to the banks to increase the liquidity so that the call rates come down. STCI and DHR market makers in dated GOI, government security and treasury bill. So in case if any bank wants to buy or sell government security, where do they approach? These two subsidiaries of RBI, STCI and DFHI. Market makers means they can buy also if you have surplus security, okay, or they can sell also if you need funds. They give a two-way quote for the securities which make the market for. So whenever you are a market maker, you buy and sell. Whenever you buy and sell, you always have two-way quote. The bid rate or the buying rate is always lower than the ask or the selling rate for a given security. In your foreign exchange management chapter also you have learned. Bid rate is lower than ask rate. The rate at which they will buy the security is less than the rate at which they will sell the security. And why the difference is charged? The spread between bid and ask rate accounts for the transaction cost and the normal profit from operations. So they are like retailer or trader. So they buy at low price, sell at high price. RBI intervenes to prevent the diversion of investment funds to the call money market. So if RBI thinks that the money is misutilized, they can intervene also. Okay. Because sometimes what happens, the rate of interest is very high in the call money market. I have told you 70%. In yesterday's note, it was 130%. So the bank will be tempted to borrow from RBI at a lower rate and divert it to call market where it is very high. So that is why the previous line says RBI will keep a watch. It will not allow this money to be used for call money market. Example of repo. Somewhere in your notes I have written Bank A. How does this repo works? Bank A, which is short of cash, can sell its repo securities to Bank B, or STCI allowed or DFHI allowed at rupees 96.25 with a commitment to repurchase them at rupees 96.75 after 14 days. So this is an example of repo. And how much is the income of that lender here? The difference. The difference between the selling price and repurchase price or spread represent the interest rate on the borrowed money. The repo buyer's right. What is the meaning of buyer here? The one who is lending money. The one who is lending money. Legally, the ownership will be transferred. Legally. Okay. So therefore, he has a right to trade in that security during the term of the agreement. Because you are selling means you are transferring the legal right. And therefore, if the buyer wants, means the lender wants, he can trade in those securities. Just like in your short selling it happens. You lend shares to other, but that other party sells it. But at the same time, he has an obligation to purchase from the market and return it back to you. So here also, the one who lends money can trade the security during the term of the agreement as it represents a transfer of ownership. That typically does not occur in collateralized lending arrangement. Collateralized lending arrangement means the ownership is not transferred to the lender. Only a security is created in the name of the lender. Like when you take loan from bank against your house, you are using house as a collateral. Ownership of the house is not transferred. Now, how to calculate the interest earned? How to calculate the interest earned in a repo? Expect this question for 4 mark in the exam. Tick tick, illustration work very important. Because most of the questions they ask from the study material only nowadays. As far as numbers are concerned. So this question 1 is little tricky. Okay. First, a school level formula. Interest earned is equal to fund invested into repo rate into number of days divided by 365. Okay. Now, suppose if rupees 1 crore is lent for 3 days at 5%, what is the interest income? This is like a school level question. Just check on calculator 1 crore into 5% into 3 by 365. Around 4110? Yes. This is a simple illustration of how the interest earned is calculated in a repo transaction. So if funds invested is given to you, if repo rate is given to you, number of days is given to you, apply this formula. But in many exam question earlier, they used to give you the two figures, the amount invested and the amount you will get it after maturity. and then normally you were required to find out the repo rate. Then also you can apply this formula. But little complicated question is now waiting for you. Bank A enters into a repo for 14 days, okay, with Bank B. So for how many days the amount is lent? The amount will be lent for 14 days with Bank B in a 12% GOI bonds 2017. Which is that instrument which is being used for repo transaction? Government of India bond, which had a coupon rate of 12% at a rate of 5.25%. Now what is this 5.25%? Repo rate. That is the rate of interest in the repo transaction, whereas 12% is the rate of interest on that government bond for rupees 5 crore. Okay. Assuming that the clean price be 99.42. Assume that the clean price is 99.42. In some previous lecture, chapter, I had taken clean price, means it does not include the interest accrued. And why I took that problem? Because one day we knew that I am going to solve this also. Okay. Assuming that the clean price is 99.42, initial margin be 2% and the days of accrued interest be 292. So how much interest has already accrued on the date of transaction? 292. 99.42 is the clean price. Now you have to add the interest accrued for 292 days. That will give you what is called dirty price. Dirty price means come interest price. So that is your first question. So if you know the basic concept of clean price and dirty price, you have to take the clean price and add interest accrued on clean price for 292 days. Which interest rate you will take here? 12%. Because that is the valuation of bond. So for bond valuation, you have to take interest accrued on the bond for 292 days. Second question is new for you. Start proceed. Start proceed means first leg. It means how much amount will be lent at the beginning. How much amount will be lent at the beginning? The face value of that instrument is 5 crore. But you will not loan 5 crore. You have to loan the dirty price value of that bond, subject to an initial margin of 2%. That also I will explain. Okay. So this calculation is little tricky. What is the amount which will be lent by one party? And then the last question, repayment at maturity. So repayment at maturity means what amount was lent here, and then you have to take 5.25% for 14 days, add that interest, and that will give you repayment at maturity. Is it right? So here the question is basically how much amount was lent, how much amount was repaid. And this question has got some technical concept like clean price, dirty price, initial margin, accrued interest. To do the calculation, there is an instruction. Number of days is 360. So understand the first answer. Dirty price is equal to clean price plus interest accrued. In your accounts batch also you have learnt clean price means X interest price and dirty price means cum interest price. In the market there are two ways the instrument is quoted: clean price, dirty price. If the transaction is at clean price, interest accrued will be separately paid, because the one who is holding the instrument should be entitled to interest accrued on that instrument till the date of holding, or the quote can be dirty price which includes interest. So see the basic calculation here. How much was clean price of this instrument? And what was the interest accrued? 99. Interest will be calculated on face value, right here. Interest will be calculated on face value. If face value is not given, but if the price is moving around 100 rupees range, 99, 101, 97, you assume 100. Because coupon is calculated on face value, 12%, and 292 days interest has already accrued. 360 is the instruction given in the problem. Just, dear student, check whether this answer of ICI is correct or not. Is it correct? Checked. So 109.15 is the dirty price of one bond on the date when repo was entered into. And the repo is entered into for 5 crore rupees. Repo is entered into for 5 crore rupees. So therefore, the proportionate amount will be how much? So that is my second answer. Is the first answer right? Now first what you do, there is some space on the right side. Write the meaning of initial margin. Initial margin, whenever initial margin is given, how will you adjust? The institute have not taken any efforts to explain that initial margin here. So write down and then I will explain. Initial margin represents the potential loss of value. Initial margin represents potential loss of value due to price volatility, and second, the probable cost of liquidating the collateral, following an event of default. The probable cost of liquidating the collateral following the event of default. Following an event of default. One line blank, next line. First you write, then I'll briefly explain, you'll understand. Assets that pose material risk. First write. Assets that pose material risk. That asset that pose material risk can be used as collateral. But not for their full market value. Comma, a full stop. Then next, instead, comma, a risk adjusted value is calculated. Instead, a risk adjusted value is calculated, comma, which is less than the market value. Which is less than the market value. Which is less than the market value. Full stop. Initial margin are usually seen as hedging. Initial margin are usually seen as hedging the risk on that collateral. Initial margins are usually seen as hedging the risk on that collateral, also known as haircut. Also known as haircut. Haircut word is used in the field of finance, means loss. Is it right? Then in finance we say you have to take a haircut, means you have to book the loss or suffer the loss. You have never heard. In your office you don't tell your client that now this asset is very impaired, you have to take the haircut. Or the banks usually use this term that this customer is not going to pay and therefore we will have to take a haircut on this advance. Okay. What is the concept of initial margin? A is giving a security to B. a collateral, which is in this example a government bond. But B has a risk of taking this collateral. Even though there is a collateral, there is a problem. First of all, the nature of the collateral is such that its value may change. It's a government bond subject to interest rate risk, okay, or any other risk which may affect the value itself. Like in a share, in case of a share, the risk is that the value of the share itself may change. So you don't get the entire value of the collateral as loan. Understood? Second thing, even though there is a collateral, you can't sell it and recover the full price. Can you? There may be some cost of liquidating the collateral, okay, which may give you a lower value than the market value of that collateral today. So therefore, while lending the amount, the lender will not lend the full value of that collateral. The lender will lend little less than that full value of that collateral, and that is called adjusted value or risk adjusted value. So in our example, I'll go to the previous page. This is the market value of this bond now, 1 unit, but the lender will not pay 119.9.15. He will deduct 2% and lend the 98% of this amount. That is why if you see your next calculation in your book, 100 minus 2 upon 100 is written. Is it written 100 minus 2 upon 100 for answer 2? Now what is 100 minus 2 upon 100? It is 98%. So he will give you only 98% of the value of that collateral. Okay. So that is the logic of initial margin. He gives you little less than the value. So now the first question was, what is dirty price? I have done. Understand the second answer. First leg or start proceed, which means the in bracket, right, the amount lent. The amount lent. If the total value is 5 crore and face value is 100, so how many units of bonds are going to be lent? 5 lakh. At what rate? 109.15 divided by 100 proportionately. For 100 rupees face value, the market value is 109.15. Where I have reduced. Okay, then you make it 5 crore. I think there is a typing error. I agree with you. Or you can directly multiply this 5, don't divide by 100. Whichever way you can understand, I should get something more than 5 crore rupees in my answer. Normally this is the value of that collateral on this date of transaction. But what they are doing, they are not allowing you entire value. They are giving only 98%. This 2% margin. In your book there is a typing error. 100 minus initial margin. That minus sign is missing. Okay. And now you please do the calculation and tell me how much is this answer. Anybody wants to volunteer? Is it 53483,500? This is the amount lent keeping the 2% margin. In case of share, the market margin is even very high. In share market, if you give a share of 5 crore rupees, the bank may just give you 30 or 40% of that value, 60% of that value. But in case of bond, the margin is low because here the fall in the value will not be much. And the last answer is, what is the second leg? Repayment at maturity. So repayment at maturity will be principal plus interest. What was the principal amount? 534,83,500. And on this you can present like this also in the exam. 534,83,500 principal Now here which rate of interest you will charge? Repo rate. What is the repo rate here in this example? 5.25%. And how many days? 14. But this question says take 360 days. So it is like a school level question. This is principal plus interest. Now dear student, solve and give me the answer. Institute has presented like this because this number is common. So they have taken this outside the bracket, 1 plus this into this. That's it. Anyway you present. I need 53592,695. Just check. Checked. Sure. Okay. So this way the answer will be arrived at. Okay. Understood? How to calculate the dirty price? First leg, if margin is given. If margin was not given, then don't multiply by 98%. Okay. Instead of margin word, they can use the word haircut of 2%. Accordingly solve. Now last few lines pending of that page. The heading still continues, role of RBI. After that answer, there are 2-3 points. In India, the repo market in government security and PSU bonds became very active in 1980s, long back. And the deals were generally interbank. While certain regulatory restrictions were put in place in 1987, that means some law was brought in the aftermath of securities scam. Big security scam at that time. Okay, market was in a panic mode. Many people lost their hard-earned money because banks were using this repo and giving loan to broker who were investing in the share market. RBI imposed a ban on interbank repo in 1992 in all instruments except the treasury bills. Since then, RBI has made several relaxations in regard to repo transactions. Next page, next paragraph, condition imposed by RBI in regard to repo transactions. Now, those who want to participate in this market, some regulations are there, may be useful for exam. You will have to come to this chapter. Okay, the bank should enter into repo transaction only in respect of treasury bill. So treasury bill is allowed. Notified Government of India dated security. You can also enter into Government of India dated security and private corporate bonds, PSU bonds. But in case of these bonds, it should be in dematerialized form. It should be in dematerialized form and the transactions are done in recognized stock exchange. That means these bonds are traded on a recognized stock exchange. So some control will be there. Okay. Next condition is repo transaction should be entered into only with commercial and cooperative banks and primary dealers. 3. Or in the same line, next line says, however, non-bank entities, non-bank entity means other than banks, NBFC, mutual fund, corporate, insurance company, are non-bank entities who are holders of SGL account. Write somewhere nearby what is SGL account. SGL account, subsidiary general ledger. Okay. So even non-bank entities are now allowed to do repo transaction, but they should be holding SGL account with RBI. Non-bank entities or holders of SGL account. For your benefit, I have written the meaning of SGL account is opened by the bank, for constituents, are opened by the banks for constituents who wish to invest in government securities and treasury bills. You have to approach through your bank. Okay, you have to approach through your bank. Suppose you have a bank account in HDFC bank, You have to go to the HDFC Bank, you are the constituent. Then HDFC Bank will get your SGL account opened with RBI. SGL account denotes subsidiary general ledger, which is maintained with RBI, for holding government securities and T-bills in paperless form. So non-bank entities who has got SGL account with RBI, and for that you have to open through your bank SGL account, so that you can maintain government security and treasury bill in paperless form. Then you can do repo transaction. Demat, yeah. So now the sentence I will read again. Non-bank entities or holders of SGL account with RBI can enter into reverse repo transaction with banks or primary dealers in treasury bills, notified government of India stocks and debentures or PSU bonds. They can conduct reverse repo transaction. Non-bank entity means purchase with an object of selling them. So purchase or sell price should be in alignment with the ongoing market rates. So what is the interest rate they have to charge? Market rate. No sale of securities should be affected unless such securities are actually held by them in their own investment portfolio. So you can't do future trading here. The security must actually be held by the parties. Immediately on sale, the corresponding amount should invariably be deducted from the investment account of the banks. The minimum period is 3 days. The security under repo should be marked to market on the balance sheet date. What is marked to market? Market value, fair value on the balance sheet date for accounting purpose. So that one should know what is the value of this instrument. Next is some more information about this repo and reverse repo. DFHI, STCI, primary dealers are very active in repo market, and the volume of such transaction has shown substantial increase with the call money rates move up beyond a particular level, because then RBI has to control the call rate. So they will increase the liquidity in the market by conducting the repo transactions through their subsidiaries. Of late, RBI has been conducting repo auctions for 3 to 4 days. It has become very active to mop up the excess liquidity released to the system through reduction of CRR or intervention in the foreign market. On one hand, RBI has reduced the CRR. It increases the liquidity. On the other hand, by conducting repo transaction, they try to again reduce the liquidity. Even the forex market, because lot of money is flowing into India, it is increasing the money supply. So through repo, reverse repo, they can control the money supply. And now next is repo transactions are structured to suit the requirement of both the borrowers and the lenders of the fund, and have become extremely popular of raising or investing short-term funds. An SLR surplus and CRR deficit bank. On one hand you have SLR surplus, on the other hand you have CRR deficit, can use the repo deal as a convenient way of adjusting SLR CRR position simultaneously. So sell some security, you will get cash, deposit with RBI. So CRR balance can also be maintained. So by conducting repo, you can manage CRR and SLR requirement also. Repo is a convenient instrument for asset liability management. Non-banking institutions, now see here the meaning of that non-bank entities are given. Corporates, mutual fund, financial institutions can go to repo market for meeting their short-term funds or securities requirement. But they have to maintain an SGL account with RBI. Of late, The RBI has been making efforts to develop the repo market in the country. Last 2 points. Measures taken by RBI to popularize and widen the participation in repo market include: 1. They have permitted non-bank participant to conduct repo and reverse repo transaction. Second, reduction in the minimum maturity for repo transaction to, underline, 1 day. So from 3 days to 1 day, and offering even state government security for undertaking repos. Not only central government, but recently they have allowed state government security also. So reduction in time from 3 days to 1 day, more securities are available, more participants are allowed. So this will help in popularizing the repo market. Now problems I have solved. Some question for self practice are also there on the screen for your understanding testing. MCQ will come. Okay. Do not write these MCQs. These are printed in model test papers, past exam. Okay. Only for the timing you answer on the screen. A company has a receivable of rupees 150 crore from 4 borrowers. It converts this into smaller portion of rupees 500 each and sells this to small investors in the secondary market. Thus fragmentation of loan is called. This is an exam question, May 2018 exam question for 2 marks. Only tick 2 marks. Yes. Debt unit, mutual fund, debt securitization, asset reconstruction. Today we started with this topic. Larger loans are broken into small pieces and then sold to large number of small investors. What is that called? That is called debt securitization. No, not necessary. Asset reconstruction may not be debt securitization. Asset reconstruction is generally for distressed debts, NPAs. That is, those who are not repaying, then you transfer it at a heavy discount to another specialized entity called asset reconstruction company, and then they take a lot of efforts to recover the money from those distressed assets. Whereas securitization is for normal debtors. Again, this question is in the model test paper given in ICI website. Certificate of deposit is a dash negotiable instrument. Front-ended, back-ended, face value, none of these. That means they are issued at a discount. So discount is given on face value and deducted and then you issue. Or you add the interest and then repay. Front-ended means first you deduct the discount from face value and then issue the instrument. So most of these money market instruments are front-ended. Most of the money market instruments are front-ended because the discount is deducted from the face value and then the instrument is issued. So therefore, you will write front-ended. Who among the following is a participant in money market? RBI, banker, government, all the above. All the above. Okay. One more. The following is true for certificate of deposit. An NRI can subscribe to CDs on an after-tax repatriation basis. NRI can subscribe to CD on a non-repatriable basis. NRI can subscribe without any condition on repatriation. And an NRI cannot subscribe to CDs. I have asked you to underline also and telling you that they can ask question from any statement in the notes. So NRI can subscribe to CDs on a non-repatriable basis. This chapter is over.